It may look like just a tiny number, but it has enormous power: the central bank's interest rate. This single figure determines how expensive your mortgage is, how much you earn on your savings, how stock markets behave, and even how much you pay at the supermarket. Today, we'll dive into what the interest rate actually is, how it's set, why it's so important for the global economy, and what impact it has on your everyday life. By the end, you'll see why a tiny move of just 0.25% can shift billions. The interest rate is the cost of money. More precisely, it's the rate at which banks can borrow money from the central bank. In Europe, this is decided by the European Central Bank. In the United States, it's the Federal Reserve. When the interest rate is low, banks can refinance cheaply, which means they can pass on lower rates to consumers and businesses. Loans become cheaper, investments rise, and people spend more. When the interest rate is high, money becomes more expensive. Loans cost more, borrowing slows down, and economic activity cools. The interest rate is the central bank's most powerful tool. Its primary purpose is to stabilize the economy, especially when it comes to controlling inflation. When inflation is high, central banks raise rates. Borrowing becomes more expensive, demand slows down, and prices gradually cool off. When the economy is weak or in danger of deflation, central banks lower rates. Credit becomes cheaper, people borrow and invest more, and the economy picks up again. In the Eurozone, the European Central Bank's Governing Council meets every 6 weeks. They analyze the latest data, inflation levels, economic growth, unemployment, and international risks. Based on this information, they decide whether to raise, lower, or maintain the interest rate. One important thing to know: these decisions don't show their full effect immediately. It often takes months before changes in interest rates are truly felt in the real economy. History shows us just how powerful interest rate decisions can be. In the 1970s, the United States faced massive inflation triggered by oil price shocks. To fight it, the Federal Reserve pushed rates extremely high, at times above 20%. This was painful, but necessary to bring inflation down. In 2008, during the global financial crisis, the exact opposite happened. Rates were cut to near zero in order to save banks, businesses, and consumers. During the COVID-19 pandemic in 2020, Europe even experienced negative interest rates, an extraordinary step to keep the economy alive. And since 2022, central banks around the world have been raising rates again because inflation surged due to high energy costs and supply chain disruptions. The interest rate affects us directly in our daily lives. Think about a mortgage. When the central bank raises rates, monthly payments on new loans rise as well. Higher interest rates can make the dream of owning a home much harder to achieve, but on the other hand, savers benefit. A higher interest rate means banks usually pay more on deposits and savings accounts. On the stock market, rising interest rates often push share prices down. Investors prefer safer fixed-income assets instead of risky stocks. And in the job market, low rates encourage companies to invest and hire, while high rates tend to slow things down. The central mission of the interest rate is to protect the value of money. If inflation is running hot, central banks raise rates to stabilize prices. If inflation is too low, or if deflation is a threat, they lower rates to stimulate spending. But this balancing act is tricky. Keep rates too low for too long, and bubbles can form in housing or stock markets. Keep them too high for too long, and the economy risks falling into recession. That's why central bankers are constantly walking a tightrope. Despite its importance, the interest rate is not a perfect tool. It influences the whole economy, but it cannot target specific industries or regions. And its effects often come with a delay, which means central banks sometimes react too late. Long periods of low interest rates encourage borrowing and speculation, creating debt problems down the line. On the other hand, long periods of high interest rates can crush growth and increase unemployment. That's why decisions about interest rates are always controversial and carefully watched by markets, governments, and the public. The interest rate is much more than just a number. It's the steering wheel of the entire economy. It shapes loans, savings, investments, and even the prices you see at the grocery store. Now, I'd love to hear your thoughts. Do you think current interest rates are too high, too low, or just about right? Share your opinion in the comments below. If you enjoyed this video, don't forget to hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next one. Thanks for watching and see you soon.